The trading floor went silent for 3 seconds, and in the world of silver markets, 3 seconds can feel like the end of an empire. Screens that had glowed green all week suddenly bled red as silver collapsed nearly 7% within hours of Donald Trump's departure from China, and nobody on Wall Street could explain why the crash felt so coordinated, so calculated, and so violent. Retail investors stared at their phones in disbelief, while institutional traders scrambled to protect billions in leveraged positions. The headlines blamed profit-taking, but insiders whispered something darker. They pointed toward private meetings behind closed doors, unusual movements in Asian commodity exchanges, and a sudden flood of sell orders that appeared too massive to come from ordinary traders. The timing felt impossible to ignore. Trump had just wrapped up meetings with Chinese officials discussing trade, currency tensions, and strategic resources. Then silver collapsed. Coincidence? Maybe. But the market rarely moves this aggressively without a reason buried beneath the official narrative. And then came the response nobody expected. JP Morgan, one of the largest players in the precious metals market, issued a statement that instantly triggered speculation across financial media. Analysts dissected every word, while online forums exploded with theories claiming the bank knew something the public didn't. Was silver deliberately pushed lower? Was this a trap before a massive reversal? Or was the market signaling a deeper economic crisis brewing behind the scenes? Traders who had spent years surviving volatility admitted they had never seen sentiment flip so quickly. One minute, silver was being hyped as the safe haven of the future. The next, panic flooded the market as billions evaporated in real time. Even experienced investors started asking dangerous questions. Why did the drop happen immediately after Trump left China? Why were central banks suddenly quiet? And why did JP Morgan sound so calm while everyone else panicked? Those questions became the fuel for a financial storm that spread faster than the price crash itself. Some believed the collapse was engineered to shake out weak hands before a historic rally. Others warned this was only the beginning of something much worse. But one thing became clear almost instantly. The silver market was no longer behaving normally. And whenever markets stop behaving normally, history shows that ordinary people are usually the last to discover the truth. Hours after the crash, social media turned into a battlefield of fear, speculation, and desperation. As investors searched for answers nobody seemed willing to give publicly. Videos claiming insider manipulation gained millions of views overnight, while financial influencers warned audiences that the silver collapse could trigger a chain reaction across global commodity markets. But beneath the noise, professional traders noticed something even more unsettling. Physical silver demand wasn't collapsing at all. Dealers across major cities reported rising orders while premiums on coins and bars started increasing, despite the futures market crashing aggressively. That contradiction made veteran investors nervous because it suggested the paper market and the real-world demand market were moving in opposite directions. Historically, when those two realities separate, something bigger is happening beneath the surface. And then leaked reports started circulating online claiming Chinese industrial buyers had quietly increased silver purchases before Trump's departure. Whether those reports were true or not, they added fuel to an already explosive narrative. Suddenly, people began connecting dots between geopolitical tensions, trade negotiations, and precious metal volatility. Some analysts argued China may have signaled reduced industrial demand, causing panic among hedge funds heavily positioned in silver. Others believed powerful financial institutions used the political headlines as cover for a coordinated liquidation event designed to reset market positioning before the next economic cycle. The theories became endless, but the fear felt real. Meanwhile, JP Morgan's response continued dominating headlines because the bank didn't sound alarmed. Instead, their tone suggested the move was temporary, almost expected. That detail terrified some investors even more because major banks rarely appear calm during unexpected commodity collapses unless they already understand the broader strategy behind the scenes. As Asian markets reopened, silver attempted a weak recovery, but selling pressure returned instantly, creating a psychological war between fear and opportunity. Retail traders who bought near the highs watched months of profits disappear overnight while short sellers celebrated across trading forums. Yet behind the scenes, institutional money quietly started flowing into long-term positions again. This contradiction confused everyone. Why were large players buying while headlines screamed disaster? Some believed the crash was flushing emotional traders out of the market before a massive upward move. Others warned the collapse reflected worsening industrial weakness and declining global growth expectations. The uncertainty itself became the story. Investors realized they were no longer trading simple supply and demand. They were trading politics, perception, fear, and strategic narratives controlled by people far more powerful than the average trader. And in markets driven by narratives, reality often arrives long after the damage is already done. By the second trading day after the crash, whispers about emergency meetings inside major financial institutions began spreading through New York and London. Commodity desks reportedly worked overnight, while analysts rewrote forecasts that only days earlier predicted a major silver breakout. Television experts tried reassuring audiences that volatility was normal, yet their nervous expressions revealed something their words could not hide. Deep inside the financial system, confidence had been shaken. The timing around Trump's departure from China refused to disappear from the conversation because investors understood that geopolitics and commodities are deeply connected. Silver is not just a precious metal. It sits at the center of industrial manufacturing, solar technology, defense systems, electronics, and monetary psychology. When silver crashes violently during sensitive international negotiations, people naturally assume hidden information is moving beneath the surface. Some insiders claim Chinese officials had delivered harsh warnings regarding future trade relations. Others suggested large institutions feared slowing global manufacturing demand. But perhaps the most dangerous theory involved liquidity stress inside the banking system itself. According to certain analysts, the silver sell-off may have been triggered by margin pressures, forcing funds to liquidate profitable positions quickly. If true, the crash wasn't about silver at all. It was about hidden weakness somewhere else in the financial system. That possibility terrified investors because market history shows that sudden liquidations often reveal deeper cracks later. Then came JP Morgan's second round of comments, and instead of escalating panic, the bank doubled down on a surprisingly controlled outlook. They acknowledged volatility but suggested long-term fundamentals remained strong. For experienced traders, that statement sounded less like reassurance and more like positioning. Large banks understand market psychology better than almost anyone, and every public statement carries strategic consequences. Some interpreted JP Morgan's calm stance as a signal that silver would eventually rebound sharply. Others believed the bank was simply trying to stabilize confidence before another wave of selling arrived. Either way, attention shifted from the price itself toward the motives of the institutions influencing perception. Online communities obsessed over historical allegations of precious metals manipulation, while conspiracy theories spread faster than facts. Yet even mainstream economists admitted something unusual was happening. Physical inventories remained tight in certain regions despite the paper price collapse. Mining stocks reacted inconsistently. Industrial demand projections stayed relatively stable, nothing fully aligned. That mismatch created an atmosphere of suspicion where every new headline felt loaded with hidden meaning. Investors began questioning whether markets still reflected economic reality or whether they had become giant psychological theaters controlled by leverage, algorithms, and institutional narratives. And as fear intensified, one brutal truth emerged. In moments like these, ordinary investors rarely know whether they are witnessing a buying opportunity or the beginning of financial disaster until it is already too late. The panic reached another level when independent analysts started comparing the silver crash to previous historical commodity shocks that preceded wider economic instability. Charts flooded social media, showing similarities to market behavior before the 2008 financial crisis, the 2020 pandemic collapse, and earlier periods of geopolitical tension involving China and the United States. Suddenly, silver was no longer just a metal on a trading screen. It became a symbol of uncertainty about the entire global economy. Investors who had entered the market believing precious metals offered safety now found themselves trapped between conflicting realities. On one side, inflation. Concerns, debt expansion, and geopolitical risks still supported the long-term bullish case for silver. On the other side, the violent crash suggested institutional players were preparing for something entirely different. Some hedge funds reportedly began reducing exposure to commodities broadly, while others aggressively accumulated physical assets at discounted prices. This divergence created confusion across every level of the market. Retail investors watched billionaires and banks behave differently from the public narrative presented on financial television, and that gap fueled distrust. Then another rumor exploded across trading communities. According to unofficial reports, several large Asian buyers had quietly stepped into the market immediately after the crash, purchasing massive quantities of physical silver while prices remained depressed. Whether fully accurate or partially exaggerated, the rumor intensified. Fears that ordinary investors were once again being shaken out before a major move upward. JP Morgan's analysts continued emphasizing that industrial demand tied to renewable energy and technology remained supportive long-term, but traders noticed something interesting. The bank's language focused heavily on future opportunity rather than current panic. That distinction mattered because sophisticated institutions often separate short-term volatility from strategic positioning. Meanwhile, Donald Trump's name remained attached to every major headline surrounding the event. Political commentators debated whether his meetings in China influenced investor sentiment directly or whether the timing was merely symbolic. Regardless of the answer, the narrative became impossible to separate from the market reaction itself. Fear spread not only because silver fell, but because people sensed the crash represented something larger than a normal correction. The modern financial system runs on confidence, and confidence can disappear much faster than it is created. Every red candle on the chart intensified psychological pressure. Every statement from major banks triggered fresh speculation, and every hour without clear answers deepened the feeling that powerful institutions understood far more than the public ever would. In the middle of that uncertainty, investors faced the same brutal dilemma that has haunted markets for generations. Sell now and risk missing the rebound, or hold through chaos and risk becoming the final victim when the real truth eventually emerges. As the week progressed, financial journalists began uncovering strange trading patterns that only deepened the mystery surrounding the silver collapse. Data showed unusually large sell orders appearing within seconds across multiple exchanges, triggering automated stop losses that accelerated the decline. Experienced traders recognized the signature immediately. This was not emotional retail selling. This was institutional scale pressure capable of moving global markets with terrifying speed. The realization sparked outrage among smaller investors who believed the game had once again been tilted in favor of massive financial players. Forums dedicated to precious metals exploded with accusations of manipulation, while veteran market participants warned newcomers that commodity markets had always been battlegrounds dominated by leverage and influence. Yet despite the anger, one fact remained undeniable. Silver prices had crashed, and billions in wealth had vanished almost instantly. Some investors who bought heavily during the recent rally faced devastating losses, while others viewed the collapse as the opportunity of a lifetime. JP Morgan's response continued hovering over the entire situation like a shadow, because the bank maintained a measured confidence that contrasted sharply with the public panic. Analysts from competing firms offered more cautious language, but JP Morgan repeatedly emphasized structural demand tied to industrial growth and renewable technology. To some, this sounded reassuring. To others, it sounded calculated. People began asking whether the bank had anticipated the move before it happened. Online speculation reached extreme levels, with theories ranging from coordinated short attacks to strategic accumulation campaigns designed to force weak hands out of the market. Meanwhile, broader economic concerns intensified. Manufacturing data from several regions hinted at slowing momentum, and fears of recession returned to headlines around the world. Investors suddenly realized silver sits at the intersection of two competing forces. It benefits from fear-driven safe haven demand, yet it also relies heavily on industrial activity. If the global economy weakened significantly, industrial demand could fall. But if monetary instability increased, investment demand could surge. That contradiction made forecasting nearly impossible. Every analyst seemed trapped between bullish long-term fundamentals and brutal short-term volatility. Trump's China visit remained central to the story because geopolitical relationships increasingly influence commodity markets in unpredictable ways. Tariffs, supply chains, currency tensions, and strategic resource competition now shape investor psychology almost daily. The silver crash became more than a financial event. It evolved into a symbol of how fragile modern markets have become in an era where political headlines can erase billions within hours. And behind every screen flashing red, ordinary people faced painful consequences. Retirement accounts shrank, margin calls destroyed savings, emotional decisions multiplied under pressure. In the chaos, one lesson echoed louder than anything else. Markets are not simply driven by numbers. They are driven by fear, power, timing, and narratives, carefully shaped by those capable of moving the system itself. Late Friday evening, when most retail investors had already shut their screens in frustration, a new wave of institutional buying reportedly entered the silver market quietly through overseas trading desks. The move was subtle enough to avoid mainstream headlines, but significant enough for experienced traders monitoring volume flows to notice immediately. After days of relentless panic, the sudden appearance of strategic buyers changed the emotional temperature of the market overnight. Questions emerged instantly. Were these bargain hunters stepping in after an overreaction, or were powerful institutions positioning ahead of information the public still did not have? The uncertainty created a strange psychological split. Some investors felt hope for the first time since the crash began, while others feared the bounce was merely a temporary trap before another devastating leg downward. Throughout the weekend, financial podcasts, independent analysts, and market commentators dissected every available clue. One recurring topic dominated nearly every conversation. Why had JP Morgan remained so calm while panic consumed nearly everyone else? Large banks rarely speak casually during periods of extreme volatility because their words influence billions in capital flows. Every sentence carries strategic weight. Some believe the bank understood that long-term silver fundamentals tied to electric vehicles, solar energy, and advanced electronics remained incredibly strong despite short-term fear. Others suspected the institution had benefited directly from the collapse through sophisticated hedging strategies unavailable to ordinary traders. Meanwhile, physical silver dealers in several regions reported tightening inventories as retail buyers rushed to purchase discounted coins and bars. That divergence between physical demand and futures pricing became impossible to ignore. Historically, moments when paper markets detach from real-world demand often precede major corrections or reversals, yet nobody could predict when or how that reconciliation would occur. Trump's departure from China continued casting a massive shadow across the narrative because investors instinctively connect geopolitical events with strategic commodities. China remains deeply connected to industrial metal demand, manufacturing infrastructure, and global trade flows. Any hint of changing economic relationships between Washington and Beijing can ripple through commodity markets instantly. Analysts debated whether investors had overreacted to political symbolism or whether hidden concerns about future trade tensions justified the fear. At the same time, broader anxieties about central bank policy, inflation, and economic slowdown continued pressuring sentiment globally. Silver had become the battlefield where all these fears collided simultaneously. For ordinary investors trying to make rational decisions, the environment felt almost impossible to navigate. Every bullish argument was matched by a terrifying bearish warning. Every rebound sparked hope before fresh selling returned. And through it all, the financial elite appeared strangely composed. That contrast fueled growing suspicion that the public narrative represented only a fraction of the real story unfolding behind closed doors. In markets dominated by leverage and information asymmetry, confidence itself becomes a weapon. And during the silver crash, confidence was disappearing faster than anyone expected. By Monday morning, attention shifted toward whether governments or central banks would indirectly respond to the growing instability spreading across commodity markets. Investors remembered how rapidly financial stress can move from one asset class into broader economic systems, especially when fear dominates sentiment. Silver's collapse had already damaged leveraged funds, shaken retail confidence, and triggered intense volatility across mining stocks. But the deeper concern involved psychology. Modern financial markets depend heavily on perception, and once traders begin suspecting hidden instability, panic can spread independently of actual fundamentals. That possibility became increasingly dangerous as rumors circulated about liquidity concerns among certain institutional players exposed to commodities. Analysts debated whether the silver crash reflected isolated speculation or whether it exposed underlying weaknesses tied to debt, leverage, and slowing growth. In the middle of this uncertainty, J.P. Morgan once again attracted attention after several analysts linked to the bank reiterated optimistic long-term forecasts despite acknowledging short-term turbulence. To many retail traders, the contradiction felt almost surreal.